Good morning, students. Today's topic is classification of capital. This topic's objectives are objectives understand the basic concept and sources of capital associated with the cost of capital. Explain what is meant by marginal cost of capital and determine the cost of long-term debate and explain why the after-tax cost of debate is the relevant cost of debit. Determine the cost of preferred stock. Calculate the cost of common stock equity and convert it into the cost of retained earnings and the cost of new issues of common stock. Calculate the weighted average cost of capital WACC and discuss alternative weighting schemes. These are the objective of this question. And the next is introduction of this topic, classification of capital. The word capital has different meaning in different professions and context. If a company is limited by shares, then the term capital means share capital. Let us see the various classifications of capital like nominal capital, paid capital, paid up capital, etc. And next is the capital. In simple word, the total contributions made by people to the common stock of the company is the capital of the company. Further, a share is the proportion of the capital to which each member has entitlement. Remember, a share is not an amount of money, it is an interest, including different rights in the contract. And the contract five ways in which the term capital is used in company law. Nominal capital, issued capital, subscribed capital, called up capital, and paid up capital. These are the five ways in which the term capital used. And first of all, we discuss all the capital in one by one. The first of all, we see the capital is nominal. Nominal or authorized or registered capital. This is the section 28. In section 28 of the Companies Act 2013 defines nominal capital is the amount of capital that the memorandum of the company authorizes as the share capital of the company. Hence, it is the registered amount authorized that can be raised by issuing shares. And this nominal capital is the company also pays stamp duty in this amount. Typically, you can calculate nominal capital by taking into consideration the working and reserve capital needs of the company. And the next is the capital. Issued capital is a part of the authorized capital offered by the company for the subscription. This includes the allotment of shares. Section 250 of the Companies Act 2013 offers these definitions. Further, it is mandatory for companies to disclose its issued capital in the balance sheet schedule third of the act. And the next capital next is subscribed capital. And subscribed capital section 2 is 86 of the Companies Act 2013 defines subscribed capital as the part of the capital being subscribed by the members of the company. It is the number of shares that the public takes. Public takes the further if the company states authorized capital in any communication like notice, ad- advertisement, official business letter, etc. Then it has to also specify subscribed and paid up capital in equally conspicuous characters. And also, Section 60 of the Act specify the defaulters in this regard. The company and all officers who default will be fined around rupees 10,000 and rupees 5,000 respectively. And the next capital is called up capital. Called up capital according to section 215 of the Companies Act 2013 called up capitals is the part of the capital which the company call payment. This is the total amount that the company calls up on the issued share. And the next is the paid up capital. Paid up capital is the part of called up capital. Actually, paid or credited by shareholders on the issued shares. Mathematically, paid up capital is equal to called up capital minus calls in errors. In errors, the paid up capital represents the money that the company has not borrowed. Also, it is the total amount of that the company receives from shareholders in exchange for shares of stock. These are the capital. And the next is, what is capital? Capital is broad term that can describe anything that confers value or benefit to its owner, such as a factory and its machinery, intellectual property like patent or the financial assets of businesses or an individual, while money itself may be constructed. As capital is more often associated with cash that is being put to work for productive or investment purposes. And this purpose in general capital is a critical component of running a business from day to day and financing its future growth. Businesses' capital may derive from the operation of the businesses or be raised from debit or equity financing. And the capital of a business is the money it has available to pay for its day to day operations and to fund its future growth. The four major types of capital included in working capital, debit, equity, and trading capital. Trading capital is used by brokerages and other financial institutions. And the any debit capital is offset by a debit liability on the balance sheet. The capital structure of a company determines what mix of these type of capital it uses to fund its businesses. Economists look at the capital of a family, a businesses, or an entire economy to evaluate how efficiently it is using its resource. And the next picture, classification of expenditures. Expenditure of capital expenditure, revenue expenditure, and deferred revenue expenditure. These are the expenditure classification. And the next is the understanding capital. From the economist's perspective, capital is key to the functioning of any unit, whether that unit is a family, a small business, a large corporation, or an entire economy. Capital assets can be found on either or current or long term portion of the balance sheet. These assets may include cash, cash equivalents, and marketable securities, as well as manufacturing equipment, production facilities, and storage facilities. And the next is how capital is used. This capital is used by companies to pay from the ongoing production of goods and services in order to create profit. Companies use their capital to invest in all kinds of things for the purpose of creating values, labor, and building expansions are two common areas of capital allocation. By investing capital, a business or individual seeks to earn a higher return than the capital costs. And these capital used in that at the national and global level. Financial capital is analyzed by economists to understand how it is influencing economic growth. An economist watch several metrics of capital including personal income and personal consumption from the Commerce Department's personal income and outlays reports capital investment also can be found in the quarterly gross domestic product report. And the next is the business capital structure. A company's balance sheet provided For matrix analysis of a capital structure, which is split among assets, liabilities, and equity. The mix defines the structure, debit financing represent a cash capital set asset that must be repaid over time through scheduled liberties, and the equity financing, meaning the sale of stock shares, provides cash capital that is also reported in the equity portion of the balance sheet. Debit capital typically comes with lower states of returns and strict provisions for repayment. The some one of the key metrics and for analysis, business capital are weighted average cost of capital, debate to equity, due debit to capital, and return to quality. These are the weighted average cost of capital. And the next capital, equity capital. Equity capital can some come in several forms. Typically, distinctions are made between private equity, public equity, and real estate equity. And private and public equity will usually be structured in the form of shares of stock in the company. The only distinction here is that public equity is raised by listing the company shares on a stock exchange, while private equities is raised among a closed group of investors. This is the equity capital. And when an individual investor buys share of a stock, he or she is providing equity capital to a company. And the biggest splashes in the world of rising equity capital 2000 equity capital 2020 new issues appreciate from young companies included Pantire and Doordarshan and Airburn. The next is the working capital. This is the equity capital, and the next is working capital. Working capital companies Working capital is its liquid capital, assets available for filling daily obligations. It is calculated through the following two assessments: current assets, current liabilities are not there, accounts rev- receivable, receivable, and interventory is at, and the minus is accounts payable. And the working capital measure a company's short term liquidity. And this working capital more specify specifically, it represents its ability to cover its debits, accounts payable, and other obligations that are due within 1 year. And note that working capital is defined as current assets minus its current liabilities. It's company that has more liabilities than assets could soon run most of working capital. And the next is, what are the three sources of capital? The three sources of capital most businesses distinguish between working capital, equity capital, and debit capital, al- although they overlap. Working capital is the money needed to meet the day to day operation of the businesses and pay its obligations in a timely manner. And the equity capital is raised by issuing shares in the company, publicly or privately, and is used to fund the expansion of the business. And debit capital is borrowed money on the balance sheet. The amount borrowed appears as a capital asset, while the amount owned appears as a liability. Is money capital? Is money capital? And the classification of the capital is there. First of all, we classified the capital and the fixed, first of all, fixed and circulating capital. The fixed and circulating capital, fixed capitals are continuously used in the process of production. For instance, machines, tools, equipment, are etc. And on the other hand, the capital which are used for single time, that is one time used, capitals are called circulating capital. For example, coal, petrol, and raw material, etc. These are the fixed and circulating capital is. And the next point, sunk and floating capital. The capitals which remains fixed and cannot be shifted from one place to another are called sunk capital. Factory, machines, etc. are shrunk capital. And however, floating capitals are those which can be used for several purposes or by several industries. For example, money and other raw materials are the example of floating capital. And the next is domestic and foreign capital. Domestic capital is that capital which includes all private and public capital in a country, the buildings of all the factories, both private and public, are the example of domestic capital. On other hand, foreign capital is that capital which is by owned by two or more countries. Kosi project owned by India, Nepal, International Monetary Fund, and the World Bank, etc. This is the more countries and types of many project in their countries. Kosi project owned by India and Nepal, International Monetary Fund, IMF, World Bank, etc. are the examples of foreign capital. And these foreign capital example of and the is next is the personal and social overhead capital. Capital having personal or private ownership is called personal capital. The big factories owned by many industrialists are the example of personal capital. On the other hand, capital which is owned by the whole society is on is as known as social overhead capital. And for example, road roads, hospitals, railways, parks, universities, etc. These are the social overhead capitals. And these capitals are personal, social overhead capital. And the next capital is human and non human capital. Human capital refers to those personal qualities which can either be seen nor has any shape or rise. And the capital is an in shape or size, hence cannot be transferred from person to person. Thus, skill, ability, efficiency, etc. of a doctor, teacher, sportsman, pilot, etc. There are the examples of human capital. On the contrary, non human capital is the capital which can be transferred from one place to another. For example, machines, tools, factories, and equipments, or etc. These are the examples of human and non human capitals. In this picture, non profit organizations, difference between capital and revenue, and classification of capital and revenue. And the classification of the capital and the revenue is capital receipt, capital, capital payment, and their receipt and deferred revenue expenditure, and capital payment is payment and revenue payments. Revenue receipt, revenue, or the revenue payments. These are the classification of capital and revenues. And the next is the importance of capital. It is the basic factor of production. And next is it arranges raw materials for production. It is the basic for all types of trade. It is important from the point of view of credit. It is provides employment, and it is the basic of technological development. These are the important of capital. And these importance, we see the next examples of capitals. All type of raw materials used in production are capital. And the next is buildings used in production are also capital. And the third one is the money deposited in bank, that is bank deposit is also capital. The magazines and newspapers which are found in the reception room of an office, are also considered as capital. And the last is the Indian Museum, Victoria Memorial Hall, etc. are also capital. And the next is money capital. Several economists have several opinions on this confusing issue. That is, can money and capital are same? Are the answer is obviously in the negative because money cannot be used as inputs in the production process, and this money capital is in the money itself, is not a mean of production. However, with the help of money we can buy capital goods which are used directly during production. And the next is the classification of company capital. Capital is essentially needed by an organization which is profitable or non profitable. Capital is the money or a monetary value by which a firm runs its activity is called the capital of the concerned firm. And the concerned firm, all businesses must have capital in order to purchase assets and maintain their operations. By nature and by law, we can classify company capital. Company capital in various classes. The classifications of a company capital are given below. In this is the classification of company capitals. And the next is the picture and next is the authorized and nominal registered company capitals. All amount of capital of a company is mentioned in the memorandum of association of registered by the authority is called the authorized or nominal or registered capital. That means a company is registered on the amount of capital is called authorized capital. And for example, the authorized capital is Sonali Bank Limited is TK 1000 crore. The bank can collect capital up to TK 1000 crore from shareholders. And this is the authorized and nominal registered capital. And this picture transaction capital revenue, capital receipt, capital expenditure, and revenue receipt and revenue expenditure. These are the transaction of capital and review. And main feature of capital, Main features of is capital is the result of past labor, the machines, tools, equipment, etc., used for the further production of wealth are the products of labor. And the capital is productive, it is used along with other factors of production like land, labor, and an entrepreneur of to produce goods and services. Capital is prospective because accumulation of capital yields in income. This feature explains the supply side of capital. And the next is capital is not permanent, it is temporary as nature and has to be reproduced from time to time. And capital is a mobile factor of production. It is not the free gift of nature. Capital is a passive factor of production. It alone is unable to do anything. It produces goods and services along with other factors of production. These are the explanation of capital and the classification of the capital. This is all about the topic and the topic and the references is there. These are the references of this topic, and at the end of this topic some multiple questions is there. The first question is the major current assets are cash and marketable security, accounts receivable, debtors, inventory, stock, and all of the above. The answer of this question is all of the above. And the basic current liabilities are accounts payable and bills payable, bank overdraft, outstanding expenses, all of the above. And the answer of this question is all of the above is the answer of this question. And the end of the question, there are two concepts of working capital: gross and zero, net, cumulative, and distinctive. The answer of this question is net. Net is the right answer of this question. And next question is dash working capital refers to the firms invest in current assets. And first option is zero, next net, and gross, and the distinctive. The answer is gross. Gross working capital refers. And the next question, dash networking capital occurs when current liabilities are in excess of current assets. First is positive, negative, exclusive, zero. The answer of this question is negative. Negative is the right answer. And the next question, investment in current assets should be. First option is just adequate, more, less, maximum. The answer of this question is just educate. And the next question of this topic, just investment in current assets should be just educate, more, less, maximum. The right answer of this question is just educate. And the next question is one on the basis of dash working capital is classified as gross working capital and net working capital. The right answer of this question concept, time, future, work. The right answer is concept. And the next question on the basis of dash working capital may be classified as permanent or fixed working capital. Second, temporary or variable working capital. Concept, time, future, work. On the basis of time, time is the right answer of this questions. And the next question, heterogeneous cash flows can be made comparable by discounting technique or compounding technique. True and false. The answer is true. Investment. Next question is investment is the employment of funds or assets to earn return. True or false? The answer of this question is true. This is the all about the topic classification of capital. All questions are completed in this topic, and at the end of this topic, thank you.